investing is relatively simpler compared to trading. The guiding principles of investing have been same for hundreds of years. And there are primarily two approaches to investing. One is value investing and second is growth investing. Value investing is the oldest approach which has made fortunes for people like Warren Buffett, Rakesh Jhunjhunwala or Radhakrishnan Damani. When someone is a value investor, they look for true value of the company and they are very conscious of the price they pay to purchase that security. When you are a value investor, you are concerned about the assets of the company, the business model of the company, the potential to consistently generate cash flows for investors, the profitability of the company, the size of opportunity of the company. All these factors are taken into account to figure out the true value of company. And what the value investor does is they try to purchase these companies as close as possible to the value of the company. Now, value of a company is always an estimate. There is no precise figure. Now, there are times when due to market conditions, economic conditions, geopolitical conditions, the prices go way down below the value. Something that you already saw in March 2020. After the pandemic, the market corrected substantially and the prices that you saw were unimaginable. And someone who bought at that price is probably going to compound their wealth at 10 to 15% for a long period of time if the company is robust and has longevity. The second approach is growth investment. Now, it is not possible to always find companies where the price is close to the value. And so, we have to pay a premium. Now, this premium has been paid for superior businesses which consistently have growth in their sales, which ultimately results into growth into profits and cash flows for an investor. And hence, companies like Bajaj Finance, which have substantially grown their user base since 2017 and 18 to now, have substantially also increased in profitability and their cash flows for shareholders. And so, you normally find them trading far above their value. But people are comfortable to pay because the growth compensates for the higher amount that it is being paid for. So, technically, growth investing is an art of investing with companies which have a potential for a huge growth. Recently, there has been one more addition to a way of investing in companies which don't have cash flows. Now, for years together, markets always believed in investing in companies which had positive cash flows and were profitable. Only then they could be valued. But today, there has been change in the environment of how businesses are done. We have amazing startups like Amazon, Google, Swiggy, Zomato, which are huge businesses, successful businesses. But most of them didn't make profit in their initial years. For example, Amazon, which started in 96, only made profit in 2016. Now, why this happens is because company in its initial years invests huge amount of capital in order to build technology, manpower, management, product, and market. The idea is to create a moat and cut the competition so that the company can create huge amount of profit and cash flows for their investors in the futures. Now, some companies have successfully done it like Amazon. But then there are also other companies which have failed to deliver that promise. Recently, we have seen Zomato being listed on the stock exchanges. And people are skeptical about the business model, about when the company will generate the cash flow. And if an investor invests at this price or at this value, how much return can he expect after being invested for 4 to 5 years? Now, that will totally depend on how Zomato grows, fights competition, at the same time makes his business model profitable. Now, the biggest advantage of investing is compounding. Compounding by Warren Buffett is the eighth wonder of the world. And this is because compounding has great power. It's like making your money work for you and grow faster. With compounding, you can have a small amount of capital which can grow into a fortune like Warren Buffett. Because when you are investing in a company, you don't only invest your capital, but year on year, till you're invested, your profits keep on getting reinvested and they also earn returns. And hence, when you start with a compounding rate of 10 to 15%, and when there is growth, the compounding rate over a long term can increase up to 25 to 30%. Imagine your wealth increasing at 15 to 20% year on year. That is what creates wealth, and that is the power of compounding. Now, despite creating so much wealth, investing has a huge tax advantage. And why it is a huge advantage is because when you're normally taxed 25 to 30% in other businesses or flat tax rates in trading, when it comes to investments, you have an option to be invested for a long time and take benefits of long-term capital gain tax. Till 2017, there was no tax if you were invested in a security for over 3 years. Even if the tax was introduced, they were 10 to 15%, which are relatively less compared to other tax slabs in other businesses. Now, saving of 10-15% is an addition to your capital, which you can use in order to invest again in markets and grow them. That's real power. That's earning 15 to 10% there and there. Along with tax and compounding, you have peace of mind, because investing requires least amount of decision. Once you have identified a security or set of securities and you're invested, your only job is to see if the business is on right track of growth, profitable, is the management good or not. When you're invested, you're least concerned with external macro factors around it. For example, Warren Buffett says that he is never worried about what happens to economy, geopolitical situation. Only if the business has a great business model, a great management and a product that will be relevant for years together, then he can sleep at night peacefully even if the market was shut for 5 years. Because when you take fewer decisions, your probability of becoming successful is much higher. Because as discussed before, the more decisions you take, your chances of making an error are also higher. At the same time, investment gives you a lot of opportunity and a lot of other free time to have a quality of life. For example, you can also pursue your professional career or start an enterprise or just be retired. That's it. Investment does not require your commitment as much as trading requires.